Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, September 27th, 2021. It's 11:55 Eastern Time as I'm doing the video, so we're coming up on noon, and I wanted to do an update limited to the broad markets. We'll get some other things out later today, but as far as the broad markets go, I want to take as I like to do, start out by taking a look at the short-term charts, the intraday charts, which I've been following a lot lately, and it's been my guide to kind of micromanaging positions. But then I do want to just briefly, not very long, loop out to the longer term charts because that is, it paints a big picture and it helps to formulate, my thinking even as an active trader. For example, has been before we even had our sell signal back here. This was our sell signal a few weeks ago when we broke those 60-minute uptrend lines on SPY and QQQ. Sell signal 1, sell signal 2 came right here on the break of this trading range. And then we set up a new trading range, and it had several objective shorting ops that were highlighted, add-ons on bounces back to resistance. And then, and technically, those are objective shorting ops, but I don't call them sell signals. Just my terminology, a sell signal is a break of a support level, a bearish chart pattern, trend lines, things like that. So then you did get the next sell signal here, and you got a good one. You got a gap down. There's nothing better than a gap down when you're bearish, if you're short, because it traps longs. A lot of longs would have stop loss orders just below that recent trading range, and when you gap down, those stops get bypassed. They either they're not executed if they're stop limit orders, and if they're stop loss orders, those get filled at the open the next day, and at a much lower price. So either way, there's the gap. The gap was backfilled, offering a couple objective short entries, and now look, another gap down today, and those are again check marks during a correction. You get the dip buyers that's stepping back in, figured the worst was over here, and the market's rallied, and another gap down, and that's what I like to see. So here's where we're at. We're right back to that T1 level. It was the first target back here. T1 was hit on this gap down right here, and that was again the first target from that sell signal. Then we hit T2, and it was, suggested active traders could cover there and go long for the bounce. So probability of a bounce was very high off that level. It was my final and only near-term target, but then I gave you longer-term targets on the daily charts. And so bounce target range was from T1 up to the backfill of that gap. We did have a reaction on the initial tag at T1, then we went and backfilled the gap, and second failure there. So that's where we're at. So far so good. But here's what's going on right now. We're consolidating right around all day. These three candles, 60-minute candle stick chart. So these are the first three candles of the day, and they're right around that T1 level, which was further validated right there with that reaction high on that opening candle right there. So there it is. And here's what we need to do. Bears want to see us break out below that support level. There's been a few trades through it, but each candle's closing right around on it. So this is what I'm leaning. I strongly lean towards. I think we're going to get that. Should we bounce again? Look, this is just even more formidable resistance now. I mentioned it as resistance back here. The fact that we've had numerous reactions, and especially a gap down off it, an impulsive rejection. There was also a gap off it right there. Helps to validate that level. So this is it. Let's keep it very simple. It's big resistance. I have no way to spin it other than bullish. It doesn't completely eliminate the bearish case, but at this point, now that we've had another rejection, it certainly would chip away at it. Let me just say that. So I wouldn't be keen on adding to shorts there. I might hold tight, and that's the final straw. 378.44. Obviously, most people will consider the break to new highs the final straw, but I think if we take that out, we'll probably do that. Now, I don't think that's going to happen. This is my preferred scenario, and we already hit my final near-term target. So my scenario is we go on down and then look at those. Go to those targets on the daily chart I showed you in recent videos, which are quite a bit lower. But here's some potential levels here on the 60-minute chart. All right, so that's that. Now let's talk long-term stuff. I'm not even going to get to the SPY. We're going to just stick with QQQ because is the market. The Qs are the market. If I say that correctly. And what I mean by that is they have the top holdings are the same in the S&P 500. They're just higher weighted, and these are market leading. These are the biggest companies in the world: Apple, Microsoft, Alphabet, Amazon, Facebook, and Tesla is up there too. So okay, what I see on the daily chart, everything I've been talking about for a long time: divergences building, this and that, overbought, momentum rolling over. Let's not forget, if you're just catching up on things, I did a video a couple weeks back going over a lot of my favorite breadth indicators. And across the board, and I have a lot of breadth indicators, dozens, different indexes, on different types of indicators, and they're all clearly saying the same thing. There's been a clear deterioration in market internals, and those are often, evidenced by divergences. Like for example, on this chart, let me color this up. You have the NASDAQ NAAD weekly. That is the NASDAQ advancing versus declining issues deteriorating. So that means you have more issues deteriorating, going down, declining, with the market going up. And again, why is that? Well, it's very simple. It's mathematics. Yeah, Apple, Amazon, Facebook, their market cap is so large, their weighting on the index is so large that they can go up, and you have a lot more stocks falling in the NASDAQ at any point in time, but it doesn't matter because their weighting doesn't drag the index down. And again, it's simple stuff. I can go back 20, 30 years. I do this all the time, show you those divergences where signatures, every bear market and all the big corrections had those similar divergences. So they're not, while they're not a guarantee of a correction, they put the odds very high. And if you get tired of me saying that for 3 months, 4 months, 5 months, just look at how long. Sometimes they take years, and each time there's little, you have a little divergence, you get little corrections along the way, but when they continue to build, the bigger they get, typically the bigger the drop, ensuing drop afterwards. And all these red lines down here, this is the NASDAQ composite down here, so you can see bear markets and the big corrections in red. All right, so same thing, and I could sit here for 45 minutes or more going over all the indicators, and they're all going to say the same thing. Clear deterioration in market internals, and again, just historically, it's a red flag or a yellow flag, however you want to call it. And divergences and things like deterioration of market internals are not a sell signal. It's a condition that can last very long. Just like any illness, you get sick, you can be sick for months, years before, if it's something terminal, before it finally gets you. So it's the same kind of thing. And then sometimes, guess what? You beat the odds, and you end up kicking it, whatever it is, and living a long life. And in that case, with the markets, what would happen is these, all of a sudden, these indicators, breadth would start to improve. You'd see more and more stocks rising than falling, and you'd burn through the divergences. Possible, but again, not probable. Okay, so I've given you a kind of a rough roadmap in recent weeks on where I do think we're going. If you're wondering, I'm going to bite, Randy. I'm going to be short. I'm going to hold on, ride out counter-trend rallies, or strategically short on bounces back into resistance and or breaks of support. I'll layer into those positions. Where are we going? Well, again, minimum I think on NASDAQ 100 QQQ is about this 343 area. You also have the 200-day moving averages right here, and that's what I think. I think we're going to visit the 200 days at minimum again on the indexes. And for QQQ, that's going to be about a 8-9% drop from where we closed on Friday. SPY, that's going to be about the same, I think. 7, maybe a little less, till we get down there. Certainly break them, or at least overshoot them. If we do, there's a pretty good support level on SPY down there, about 397, where we'd probably get a bounce. That'd be about a 10.5% drop from where we're at right now. Okay, so now I'm just going to go over to the weekly charts, and then we'll wrap this video up, so it's not a very long one. What do I see here? Well, this is SPY, the S&P 500. This is a sort of a near-term, well, it is an uptrend line that came, remember, off the COVID drop back into March of 2020. we had a very, near vertical descent, and then we snapped back, and then this is where trading sort of normalized, the trend sort of normalized, and there's a trend line there which was taken out, I mentioned a couple weeks ago, and that gave us, for the first time in a while, a sell signal on the weekly chart. So whereas focus on, first we got it on the 60-minute charts, and then the daily. Now we have it, or we had it a couple weeks ago with those red candlestick closes on the weekly chart. Now the other things to note too is, and let me jump back to QQQ because that's where my focus has been. You can see everything here: divergences, PPO histogram is bearish, and that typically denotes bearish trends. Here, let me show you what I'm talking about. Down here, that's one thing to look for. You look for divergences on the PPO histogram as well, which we've had building for quite a while, just like we had divergences building into that 36% drop in the S&P when COVID first hit. So, it wasn't random. COVID might have been, certainly it was a black swan event, but again, technicals were building into the charts for a big correction, big multi-month, even multi-year divergences up to that point. So it was one of the fastest, it'll go down in the record books as one of the fastest bear markets in history because the Fed, came in with the nuclear option. But it is what it is. I just want to say that it may have been a random, unforeseen event as far as what COVID was, but again, priced into the charts technically that a big drop was coming, so we got it. QQQ, so same thing. I'm going to just hit on the salient points here. PPO histogram divergence, just like you had the divergence before the big drop in February to March of 2020, just like you had divergence on the PPO back there, that big fourth quarter 2018 drop, roughly 20%, and so forth and so on. Positive divergence on the indicators. Let me park the PPO histogram, other than just saying that it's now crossed over, and as I mentioned, that's one thing I look for. So there was a bearish cross because these lines go red. That means the PPO right here made a bearish crossover. The histogram just helps you see it visually when these two lines cross. The white, and here I have them white and blue, the PPO line and the signal line, the 90 MA. But again, they're pretty good guides. This is kind of a whipsaw. I look for these big hills, and what happened is we got a sell signal there, and it never really panned out. We had a little whipsaw. The markets have gone into a period of low volatility, but quite often when you get these big green hills like this, it's those crossovers, and if they'll come early in a correction, and it tells you the trend has changed. And again, this is a weekly chart. If you're looking at trying to go long or short, bullish or bearish PPO crossovers on the 60-minute chart, you're going to get whipped up pretty good. A lot of whipsaw signals. But you get fewer and fewer when you go out farther in time. Again, this is a weekly chart. There's a nice one there, nice one there, quite a few. You go back in time. And then if you go even farther, you go out to a monthly chart. I don't have it up, but you're going to get even fewer crossovers, and they're going to show you, because remember, the PPO is a momentum indicator. They tend to do a good job of signaling bullish and bearish trends. You might not see a big drop, but when it crossed, remember, it crossed right here, and there was a big drop in there. I'm going to measure it out for you. It doesn't look like a lot, but during that period, we dropped 26%. That's from high to low right there. And again, this is a monthly chart, monthly candlesticks, but that came shortly after that PPO crossover. So again, it's all about just looking at those trends, bigger picture stuff. Now, we haven't crossed yet, but you can see the PPO is losing momentum, as it always will before a crossover. It's going to go down. You typically get divergences, those lower lows. Then you get the crossovers. And again, just go back in time and look, and you can see that's usually when the market has lost momentum and the trend changes. These, I will say, are whipsaws. Nothing's 100%. Even this one, but I showed you a 26% drop in there, and about almost 2 years of a sideways market back in 2015 to 2016. So the market went flat. You could have took your money out, put it in a savings account and done better than that, or sidestep that big loss. So there it is. And again, that was a 20-something% drop there. That was in the S&P, at least a 36% drop. So pretty darn effective. And so we're not there yet. I'm just going to say it. There's no sell signals on the monthly chart. The most important, one of the best indicators that I have, I love this one, the 20-month exponential moving average, that blue line. And again, monthly chart, so all that matters is the close of a monthly candle. See that little skinny part? We call that a tail or a shadow. The skinny part, whether it's above or below, is a shadow. Down below, they call it a tail. Above, it's called a wick. And so that means intramonth we pierced it. But and that's why you don't jump the gun. I like to wait for the candlestick to finalize, and that means on a monthly candle it's not going to finalize to the 4 p.m. on the last trading day of the month. And you can see it's just done a phenomenal job of saying bull trend when you're above that line, boom, breakdown, bear market or bear trend. And on a monthly chart it's pretty much a bear market when you get a sell signal on the monthly. Boy, the last time we had it here, you can see that we're still pretty much since 2009, even back when COVID hit. Look at that, the monthly candle closed back above there. See that body right there, closed above the 20-month, and the green, that big green candle, also closed above it there. So pretty cool stuff. Now we're well above it, so I want to just say that. So no sell signals now on the monthly chart. The sell signal could morph into that over time. But we're going to take this video home by just looking at the FAAMGs real quick and sticking with the weekly chart for now, because as I just showed you, nothing's going to happen anytime soon short of a market crash in the next, well, really it's a monthly, so we're on, today's September 27th, so we're certainly not going to get a sell signal this month. At best would be an awful bloody October, so, and then we wouldn't know till October 31st or whatever the last day of the month will be for trading. All right, so what do I see here? Weekly chart, again, divergence on the PPO, a recent bearish PPO crossover, which is worth noting. You get more whipsaws on the weekly. Divergences have continued to build on the RSI and the PPO. All my indicators have divergence. And I'm going to look at the FAAMGs, and we'll wrap this video up, and I'll get it out to you guys. This is Apple. And Apple has a history. You can see I'm rolling back into the early 2000s here, and it's pretty simple stuff and pretty reliable. As big as it is, that company has big corrections, has a pattern of making these divergent highs. I'm gonna close the histogram out to just show you that let me start there. Let me just start on the histogram. Sorry guys, I'm kind of all over the place here, but there it is. We've had, actually it's the second week. Last week we got a sell signal, a crossover, a bearish crossover. See that red little line right there? That means the PPO made a bearish cross, and it's even lower today, the histogram. So this histogram, this bar can change. If Apple rallies up by the end of the week hard enough, that would turn green. It means the PPO could cross back over by 4 p.m. on Friday. But as of now, it's quite a bit below that. So that's one thing I'll watch for. And why? Again, here was a crossover. This has been an unusual period. We've had a lot of, things, trend indicators signaled, flipped over, but yet the market and a lot of stocks pretty much went sideways. From that point to that point right here, like I said, we didn't go down. So if you want to call it a failed sell signal, the fact that a short wouldn't have panned out, but you could have got out of your longs. Apple went pretty much nowhere for months there when that happened. But again, nothing's 100%. You go back in time and look at all the other signals that were given. There's one right here. And there was, that was early on in the 35% drop in Apple. Here was one right here. That was early on in a 39% drop in Apple. And I'm measuring again from the high to low, and so forth and so on. So you can see, not a perfect track record, but a pretty darn good one. There was a 40%, 45% bear market in Apple, and it would have got you short early on. So I just want to mention that's one of the many things that I'm looking at here. So that's Apple. Where would Apple go? Well, depending on what happens going forward and how many other stocks break down, or even if Apple breaks down. Look, Apple hasn't even triggered a sell signal for me. It's given that bearish PPO crossover, but price-wise, I want to see it break this trend line. Put in a divergent high right here, and it's not as if that didn't work. There was a 21% drop in Apple off that first divergent high right there, and this is what I call DH2. The divergence has only extended, gotten larger, and this is the best trend line I can give you. I'm not crazy about it, but I like the fact that it comes in with the 200-day moving average. Typically, not always, in a normal market. Remember, this has been a very heavily, Fed has a very heavy hand in this market, but normally the 200-day does a good job of acting as support on Apple. And if I'm confusing you, we're on a weekly chart, so I have it on here as a 40 period moving average. A 40-week moving average is the same as a 200-day moving average because there's 5 days in a week. That's 5 times 40 is 200. And again, you can see the 200-day doing a good job there. So that's why I like that trend line right there. It comes in with the 200. That if Apple takes that out, it's going to take out its 200. And that is it's an aggressive target. I can't say it with the highest degree of probability. If it was, I'd be loading up on Apple puts. Otherwise, I'm just watching this right now for a breakdown to confirm a even larger sell signal in the market, because that would be a big drop if we got it. So let me look at the rest of these for you. Microsoft, and I'm going to park this PPO just so we have a little cleaner. We can see price better. I'm going to park the PPO histogram. Before I do it, I just want to show you again, this is a common theme. A lot of these stocks have now had bearish crossovers on the PPO, and that also serves to do something else. It confirms, or at least in my book, you won't find this textbooks, but I consider divergence as potential or pending when you have the indicators making lower highs and prices making higher highs. That is the definition of textbook definition of divergence or negative divergence. But I say it's confirmed when the PPO makes a crossover, bearish crossover, because then you effectively have a lower peak in the indicator. So, and that's what we have. So I just want to say that the histogram tells me we crossed over, and that gives me confirmed divergence. However, what we don't have on Microsoft, just like Apple, is anything resembling a solid sell signal in the weekly time frame. It's still above this questionable trend line, I'll call it, because I don't have a lot of reactions. We're still above the 200-day moving average. So that's it. So I think we're going lower, but to me it's not an all-in moment. It's certainly worth being short, especially near term. And again, to quantify it, there's a levels. If you shorted, you had several opportunities last week to short the gap, to short that backfill of the gap. If you did, you're profitable now. Actually, we've been profitable. We've called this thing all the way down. We're pretty much from the top so far, and we'll see. Only time will tell if it ended at T2 on that 60-minute chart on QQQ or not. Alphabet GOOGL, this is Class A shares, has a pretty decent trend line. By that, you can go back to the drop into the March of 2020 lows, major reaction there, and then quite a few reactions along the way. So there's a trend line that will most likely bring in some sellers if taken out. Stock still comfortably above the 200-day moving average, but as you can see here, recent bearish crossover on the PPO and divergence, as well as a pretty rare extreme overbought reading. 70 is a typical overbought reading on a RSI, but for me, the magic number on Alphabet is 80. You hit that 80 level, it's that orange line I put here, which we just did. Last time we hit it was right there. Look at that, right before the drop when COVID hit. And that was, from that point, we were overbought at the 80 level, extremely overbought. We dropped, Alphabet dropped 34%. Time before that, let me turn off all the lines again. Oh, no, I need them on because that's a line I added, was right here, right there. And you can see we dropped well into the double digits and didn't end till we were down here. So a pretty, again, I always say overbought in itself is not a sell signal, but when coupled with other things. So again, that's why a break of this trend line, I'm going to tighten it up there, would most likely open the door to more selling in Alphabet. All right, guys, we're almost done. Amazon, great company, but just really stalling out, facing a lot of I think they're seeing a lot of pricing pressures. You have states like California enacting all these labor laws on them and all this other thing they're trying to pull. And Amazon's getting to that point where I think they're having growing pains right now. And again, great company. It's an earnings juggernaut. But like everything, things get ahead of themselves, and we can sit here all day long and try to figure out where it's going fundamentally. But technically, what I can tell you is big negative divergence on the PPO histogram. It's red right now. I'm going to park that. I told you I'd park that, which I didn't do before. And down here, you have big divergence on the PPO and RSI, negative divergence, and that is from right here. This recent high, there's your divergence line. Actually started right here. Negative divergence on the PPO, negative divergence on the RSI, just like we had back here when we had a 36% drop. Right before that, we had small divergent high there on this weekly chart, 14% drop, divergent high, 32% drop, 32, 30, 66, 35. You get the picture. So pretty reliable stuff. Again, yeah, where does it go? Well, here's a long-term trend line that comes off the 2009, or it's technically the late 2008 lows, and that hasn't been visited since March of 2020. Yep, when COVID hit, that was the last time we tagged it, and so that would be a logical near-term target. Let's see how much it would bring Amazon down. If we hit it, it's going to take the stock down, depending on if and when we hit it. If market starts to go lower from here, or continues lower, probably about a 17 or 18% drop in Amazon. And you also have the bottom of this, the multi-year trading range right there, and it may come down to that as well. So if you're a channel trader, here's a nice big multi-year, almost multi-year, it's multi-month for sure, trading range, and it's a simple MO. You sell the top, either get out of your longs or short, and you cover the bottom. Up, down, up, down, up, down, up, down. And this, by the way, was a false breakout, aka bear trap. You had a breakout candle there. The bear stepped in next week, or the sellers did. You want to call it bulls, bears if you want them, just metaphorically speaking. The sellers stepped in and once and shot it down. At first, it was just a back test for a couple weeks. Then, when it became clear to all that the breakout failed, look at that big impulsive move down, and false breakout from the false breakout. That was a 16% drop in Amazon, and we're back in the trading range. And again, the MO is usually once you hit the top, the next stop is the bottom. So there's my target on Amazon for you. And while I cannot guarantee you that target will be hit, what I can all but guarantee you is that if Amazon drops 17, 18%, the stock market's going down because of the heavy weighting. And even if you strip that weighting out magically, if S&P and NASDAQ just came and said, we're going to change our weightings, and Amazon give it a 1% weighting, psychologically it's going to take the market down. But again, it is mathematics more important. That's the fact that it would be highly unlikely to see Amazon drop 17 or 18%. Without the rest of the FAANGs and the market falling. Facebook, still one of the leading top-weighted components in the NASDAQ and S&P 500. Pretty well-defined trend line. Again, lots of reactions off that March 2020 low back here. Lots of reactions recently. Closed a couple weeks ago on the trend line and then broke down, gap down below it, and we're still well below it. So that is a sell signal on the weekly time frame. And again, weekly sell signals have longer term implications. Usually, signaling a trend change that's going to last for at least months, if not sometimes even years. And where to? Well, we've got the key 200-day moving average to test first. If that's taken out, I think we can come on down here to this 249.27-ish level right there. And you can see that is with support here. We had a breakout right there to new highs, successfully back tested again, rallied up, and that would be a target. And just to measure it out to see if it aligns with what Amazon's might do, that'd be about a 29% drop in Facebook. And the very last one, in recent years, I started calling them the FAAMG+Ts. Because Tesla's up there, pretty much catching up to these guys with a market cap of $726 billion. So it certainly moves the needle on the NASDAQ 100. And here's your levels up here. I gave it a sell signal and called a major, what I believe to be a major top. It's taken a while to get there. I think we're going a lot lower. I'm calling for a drop at least down to this 202-ish level right there. Over time, you can see all the stops along the way that I have. But again, we're still well off that high. This is a stock that peaked back in the end of 2020, end of 2020, early 21 back here. And it's still below there. However, we need to take out this trend line right there. Again, we're looking at a weekly chart. You need to do it on a weekly closing basis. So let me tighten it up a little, clean it up as I zoom in. But that's it. And so we're still comfortably above that trend line. And I'm going to add one more level now that I've just noticed as I zoomed in there, right about there. So there's the probably the next stop, or the first stop when the trend line is taken out. Actually, second stop. I'm going to give you one more level right here. If you are interested in trading Tesla, see some minor support there, about 626. Next support is about 548.50 or so, and then down here to 463 or so. Okay, I promised you a relatively short video. I might have lied a little bit, but I'm cut it off here. We're right at the 30-minute mark. All right, those are levels to watch, and today and really this week should be interesting because we've had enough tests of that backfill, that gap. I thought we would probably start heading down Friday into the close, shooting down, but again, I actually like it better the fact we didn't do that. It would have been easier for some longs to get out. Look at the market that way. So I see a lot of trap longs on the gap down. It wasn't a massive gap today, but enough to probably do the trick. And so that's what I'm watching for today and the next few days. I want to see some more downside in the market. And like I said, if we pop those levels, take out last week's highs and start to run, I showed you levels that I'll start to pull the plug on shorts and sit back and wait for the next opportunity if this one doesn't pan out. This has been Randy Finney with Right Side of the Chart. Have a great day.